Hi everyone. Today let's talk about your portfolio and the top 10% of earners in the US. Why are they important to you and what are they doing right now that is potentially affecting you and your portfolio? Let's talk about it. And of course, we will get into all of the normal charts and data as we look forward into the next month of trading. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So why should you care about the top 10% of earners? They spend over half of the money in the United States. Big spending from these top 10%. They are driven in part by the kind of wealth effect with their households getting bigger. Asset prices, as they go up, they feel more wealthy. But this can start to reverse if you start to see these top spenders reverse their spending. That can be a huge indicator for markets. The US consumer needs to be spending to keep this economy going. But again, if you see these top 10% earners not participating in the economy as much as they were, and this means folks earning over $250,000 per year, then that takes a huge amount of spending out of the economy. So they were at about a third about 3 decades ago, and now they're at about 50%, taking up the lion's share of the spending. So big, important spenders here, and they need to continue to feel wealthy. They need to continue to spend. Otherwise, we are going to see a recessionary environment. We are going to see that potential for weakness in the economy. You can see the great divide that they're highlighting here. The top 10% closer to that 50% range, where the bottom 50% are closer to that kind of 10% area. Obviously, there is some income inequality, and if it continues on this trend, this can be a very negative indicator for the broader markets. So are the regular consumers in trouble? They say top earners, excess savings starting to come down slowly. Top 10% earners have 1.3 trillion in excess savings by income. As these interest rates stay high, they are going to continue to save that money. Hopefully, as the interest rates come down, maybe this top 10% continues to spend a little bit more. We start to see this kind of come down a little bit. That would be interesting. You can see since the pandemic, excess savings have been significantly higher than they were ahead of the pandemic. And you can see that other 90%, they've already spent a lot of that money. They still have more than when they started, but they've spent a lot of that money. Really, you need to see this top 10% continue to spend and kind of deplete this savings if we're going to see a strong economy. But the concern here is that they're just not going to feel as wealthy as they were before. If you start to see house prices come down, we've been seeing equity prices come down. They're not going to feel as wealthy, and they might not be as inclined to continue to spend at the rate that they have been, which again consists of about 50% of US spending. So huge numbers there. Need to see that money continue to go into the economy. And you can also see here households are running out of emergency funds, getting to some really low levels. Probability of coming up with $2,000 over the next month is dipping into that kind of 62% range. You can see during the pandemic, had pretty good numbers, pretty high there. We are now well below the pre-pandemic numbers, back to where we were 2015. Not super low, still a pretty good number, but definitely lower than we were. And we have seen a significant decline in income expectations. You can see big declines here. This was the recession. We're basically back to that COVID recessionary environment in terms of numbers. You can see 2008, 2009 in a similar range. Obviously, we were lower during that period, but in a similar range as that period, and that was a very negative economic time. So are we going to see the economy head in that direction over the next couple of years? Certainly seems like that is a possibility and something to consider. We're also seeing inflation expectations start to rise up a little bit. Not super inclined to believe that. This is from Apollo, but interesting. There are expectations that it could go higher. I'm not super on board with that. I think inflation's probably pretty well tamped out at this point. I think we should continue to see the current trajectory of inflation coming down as well as interest rates coming down, but it's certainly a possibility, something to think of. Again, you can see the wealthiest Americans having the most amount of money. We've been talking about that. But realistically, what does this mean to you? And they do want to highlight here, just because the economy looks fragile doesn't mean that it's going to crumble immediately. These are things that are hard to trade. They're not something to be a short-term trading vehicle. It's just something to kind of keep in the back of your mind. As we start to see some of these indicators come in, and you start to see soft data weakening, we start to see unemployment rates start to tick up, which they are expected to tick up a little bit this week, then maybe we start to see it drift towards that kind of catastrophic or crumbling markets. But then again, we do have to think of some of the other drivers. There are potentially tax cuts on the horizon, looser regulations, AI-driven productivity, which could provide stability or growth to the markets. So not everything is as cut and dry as the kind of bearish sentiment that this article has. I do think these are very important, and I do think that they will play a role, but there are some drivers that could keep the economy a little bit more stable. But realistically, find diversification, find bonds, find things with yield. That's what I've been pointing to for a long time. The Easy Rider portfolio, we've talked about that on this channel before. Look for momentum, look for things that are doing really, really well, and kind of allocate your funds towards those. And then, of course, you can always consider hedging with things like options that we do on the channel. Looking at fear and greed, we finished the week at a 22. A week ago, we were at a 25. You can see this significant downturn that we saw at the end of the week. Absolutely terrible. Big selling across all the major indicators. You do have a maybe slightly higher low setup here on strength, but still extreme fear across all of the major indicators. Even put call ratio re-accelerating to the upside there. Volatility spiking up. I would call this a little bit higher than neutral, but they're saying neutral here. We're back well above the 50-day moving average as well. Safe haven demand turning back down. Bonds rallied on the Friday, government bonds at least. And equities obviously had a major downturn, even junk bonds pulling back a little bit. This is more concerning to me. This has been doing really, really well, but now we're back into neutral there. So potentially forecasting a little bit of recessionary environment. And I would not call this a contrarian metric, at least right now. Everything seems quite bearish across markets. Moving over to the AAII survey, you did have just a little bit more bears coming in. Remember, this was done on the Thursday, so we did not see that huge selling on the Friday, but the bears still well above the 50 line. Again, very, very bearish for the markets generally. Neutral is still getting squeezed at a 20%. The bulls coming in just a little bit on that short-term rally that we ended up seeing, but overall, I still think this is a pretty bearish metric. I still think we have a little bit more bearishness to go. Generally, I like this as a contrarian metric, but when it is so heavy and so consistent, usually that means there's just a lot of sellers in markets, and we're coming off of those record highs, so there's plenty of room to the downside in my opinion. Moving over to seasonality, we got a new seasonal calendar. You can see Aprils traditionally are pretty good, whether it's post-election or not. You can see really, really strong moves here typically for April. We'll see if that comes to fruition. I just don't believe that it will, considering the movements that we've seen in markets. This has been a pretty unusual year relative to all the others. You don't see it really lining up super well with any of the others, but for right now, April could be a bullish month. Something to keep in mind. This is seasonally a strong period. And then looking at the calendar here, we do have that Monday, the last day of March. That is usually a down day. The Russell does usually do well, but the Dow not so much. So expecting that to be a down day here for the Monday. But first trading day of the month, up 21 of the last 30. Pretty good metric there. Expecting some bullishness on the Tuesday. Maybe we get a nice little fall into the Monday. Rally with Tuesday, Wednesday, and then we'll see if we get that continuation lower or not. You can see generally a strong month, pretty green across the board, many bull heads as we head through this calendar here. So overall, pretty strong. Keep in mind you do have that Good Friday there, but overall, pretty good, up most weeks. You can see here April, the second best here for the Dow Industrial, second best for the S&Ps, fourth best for the NASDAQ. So overall, like I said, strong month. We'll see if it happens. Moving over to the economic calendar, Chicago PMI here for the Monday, expected to not be super good. We'll see if that plays out. Otherwise, don't expect a ton of movement out of that. You do have a ton of soft data here for the Tuesday, all coming out at 10 o'clock. JOLTS job openings, that's going to be interesting here for the Tuesday. Then for Wednesday, we got the ADP non-farms, crude inventories, not a whole lot there. You do have some more soft data, S&P Global Composite PMI, Services PMI, non-manufacturing PMI, Fed balance sheet, and then we get all of that unemployment data here to round out the Friday. Definitely going to be interesting. The expectation for the unemployment rate is a step up, so that's concerning already that the expectation is a step up. If it comes in hotter than that, that's going to be absolutely terrible. And then you have Fed Powell speaking there around the noon timeframe, 11:25 on the Friday. So pretty good amount of data across the board, but of course the unemployment data is going to be the biggest data for the week. Moving over to Max Pain. Max Pain is pretty bullish across the board here for the next several months. That hasn't meant a lot recently, but makes sense. Markets are continuing to dip lower. Max Pain should be a little bit higher from here. Eventually this will matter. I don't think it's probably going to matter this week, but once we get closer to that third week options expiration, I would expect it to matter a little bit more. Moving over to the SPY charts here on the weekly, you can see we were down 1.5%. Absolutely terrible. We got the touch of the trend line here. Probably should have been watching that midweek. We touched the trend line at the high. We filled the gap here and then immediately sold. Closing on the low of the candle, I would expect a continuation. The trend line is about 3.33% lower. That takes you right to this zone here, which is what we talked about on the Friday video. This is probably where we're going, somewhere around 3 to 3.33 lower. Momentum bearish, RSI bearish, as you would expect. Continuation. Here we had one pause week, one consolidation week, one slight retracement, and now we're getting that continuation. So the trend is in that 5,400 area. That's what we're looking for. Momentum, RSI, everything looks terrible. And then looking to the SPY charts, we had that kind of intermediate trend line that we were watching. We did close below it here on that Friday candle. Obviously, the 2% down was pretty rough. And then you can see that same kind of low consolidation here, the 535 level here on the SPY. So 5,400 on the actual SPX, 535 on the SPY, momentum bearish, RSI bearish. That would give you about the same, a little bit more, maybe 3.5% lower, somewhere in there is what we're looking for. You can see that next consolidation of volume. Makes sense that we would head into that area as your next zone. We also crossed below the SMA on the RSI. So again, everything looks bearish across the board, and I expect continuations lower. At a bare minimum, a double bottom, I'm expecting a lower low. Moving over to the Tasty charts here, you can see on the weekly, we did end up dipping below that 55 here as well. That lowest ATR band target would be around that 540 level. So a little bit lower on this one versus the previous charts. Takes you just below this low here. And then you can see that next support would be the 89 EMA at 531.86. Volume on the selling continues to ramp, so not good there. Momentum did kind of cool just a little bit, but I would expect this to kind of continue into this area. Between that 531 and 540 area makes sense to me based on this chart. And then looking at that daily chart here, you can see the lowest ATR band takes you all the way down to that 537.76 area. So a little bit lower as well, pretty much in line here. Just below that low we were talking about back here from September around that 540 area. So a little bit lower, 537, again, kind of in that same range, 531 to 540. Moving over to the NASDAQ here, the NASDAQ was down 2.39 on the week. So pretty much all of the selling that we saw on the Friday was what we ended up getting for the week. So same zone here, looking at that September low back here around the 18,447 area. If we did get a move to there, which I would expect that we will, that'll give you about another 4.5% lower to that low. And then we'll see if we find some support in there. In terms of those longer term EMAs, that's certainly in play at this point. In my opinion, obviously I don't think it's going to happen in 1 week, but if we do continue with this kind of waterfall selling here, you could ultimately see this go down another 18.5% to that zone. From top to bottom, that would be about 28, 29, maybe as low as 30% lower. And then if we extend out this trend line here, which is a very long-term trend line, that puts you in that same region here. So you have to consider that over the medium to long term, this is where we're ultimately going. Maybe we see a breakdown to here, rally up, retest, continuation lower down to here, something like that. The fact that we did not see the kind of continuation move up to this zone here, which is what I was thinking we were going to get, and then the continuation low for me says this is a very bearish setup. We couldn't even get a proper retracement. We got this continuation off of just a hesitation candle. If it cuts the low here from 2 weeks ago, then I think we're going quite a bit lower, at a minimum 4.5% lower over the next week to 2 weeks. And then moving over to the Qs charts, again, just to give you some levels to work with, you can see that level that we're looking at on the triple Qs is that 446.66 area. That's the low back here from 6 September. Looking at that 4.5% lower, you can see the volume profile. If we zoom out here just to get the better vol profile, takes you back into the 440, 435 area down here. That would take you to the lows from mid-August and this kind of consolidation high from April of last year. Obviously, those are much longer term theses, and we're not expecting that in the short term. Short term, though, I do think we could go to this trend. I do think we could go to this area here. 446 to 450 makes a lot of sense for me. Momentum, obviously stepping down. RSI continues to look bearish going into next week. Moving over to the Qs on the Tasty charts here, you can see we are officially in bearish conditions on the weekly chart. We should expect bearish conditions to last. It is not very often that you see this flip back and forth. You can see we got to bearish conditions back here in January of 22, and that lasted all the way till here, March of 23. So many weeks of bearish conditions. We are officially in bearish conditions here now. So you should expect that to last for a while. In my opinion, that's what we're looking for based off this official switch here this week at 457.32 is now your trailing stop to the upside. And then looking at that daily chart here, you can see that lowest ATR band, that's your short-term target. That would take you all the way down to 521.67. Are we going to get that? That would take you all the way down to 449.11. Are we going to get that low in 1 week? Hard to say. That is pretty much in line with that September low that we've been targeting in the short term. I do think that there is a strong potential we could get there. We got there pretty quickly on this kind of move here. We had a short pullback in time, attempted rally, and it was very quickly sold off. So certainly could be in play, giving you another kind of $20 of potential downside over the next couple of days. Moving over to the Russell was down 1.6%. It's actually holding that 200 SMA on the weekly chart right here in that 199.81 area. The next support 198.75. We didn't quite touch that. We touched it 2 weeks ago and bounced. Touched it again this week on the 200, but we're still looking for that 189 touch. And then your next support after that would be 195.51 at the 144 EMA. 195.15 is my level, so you're right in that next zone. In terms of volume profile, you can see we're in this profile right here, waiting to see if it ends up breaking through this zone. That 198 is kind of the low before we start to run out of volume until we look at that 185 area back in this kind of consolidation here. And then if that breaks, then your next zone is somewhere between 172 and 175 right in here for this next kind of potential zone of support. Let's go ahead and extend this out. That's going to be in play, I think, over the next couple of weeks. That would give you a target somewhere in the 182 to kind of 183.4, my level 185.6, somewhere in here makes sense. That isn't super compatible with the volume profile, but my expectation is that we would get some support in there, even if it was short term. So either way, important zone here. If it continues to hold, which I don't suspect it will, then we're in good shape. But if it doesn't, then I think we're probably headed down to that 185 area. And then looking at the daily chart here, you can see broke back below the trend after we closed below it just once here on the 13th, back above it, and now we're back below it again. So expecting that to continue to those next lows. You can see important pivot point back here at 191.89 ended up giving you a pretty solid rally of about 9% from there. This is kind of what I was looking for off of this bigger move down here. I was looking for a pretty substantial move. From bottom to top, we got about 5%. I was looking for closer to 10%. Again, we didn't get anywhere near that. So the fact that we are breaking down already says this is quite bearish, and I would expect those lower lows to come. And then moving over here to the Russell on the Tasty charts, you can see we've been in bearish conditions for a couple of weeks, about a month now bearish conditions. We flipped back here on the 3 March week, continues to be bearish. Your lowest target there would be 193.20, so about another $7 of potential downside to that short-term target. Not a ton of volume this last week, but it did end up being a big seller. And then looking at that daily chart, we've been in very consistent bearish conditions since back here. And now you can see that lowest ATR band target, which would take you down to that 193.08 area. I think that's more likely to be what we see. In terms of zones, that would take you right back to that kind of April 18th, April 15th zone here. I think that's in play. There's definitely some support area still here from that to August. That takes you back to this most recent low. But again, I'm expecting that this is going to continue through that low, give you that lower low setup in this zone here around that 190-170 area. So expecting lower lows, and this is continuing to show that as a potential. And then flowing through here a little bit quicker, we got the equal weighted S&Ps down 1.17%. These continue to hold up a little bit better than the broader markets, but I still think we're going to this highly traded zone here around the 167 area. If we did get a move like that, that's about another 4.25% lower. The support actually would be this kind of 162 area, 162.69, my level 162.57, somewhere in this kind of consolidation low. But that would be a little bit lower around that 4.5%. Momentum bearish, RSI bearish, continuing to look quite weak. We did take out this low here. We closed on a new relative low on the weekly chart, so expecting this to kind of flow into this area here with a clean top with that high, lower high setup, looking for the low, lower low setup. Is it going to go that low? Maybe, maybe not, but I do think it's going to get here eventually. Moving over to the ratios were pretty much unchanged on the SPY Russell. These kind of stayed flat here, but the NASDAQ obviously not so much. The NASDAQ was the worst performer by far. Russell and the SPY pretty much neutral there. Again, tech is leading us lower, and if the market leaders are going lower, generally the broader market is going to go lower. So that's what we've been seeing. We've been seeing this kind of distribution here. We've been waiting for this culmination point, and now it looks like the NASDAQ is going to continue to lead us lower. This ratio's probably got another 3% in it, so I would expect markets to kind of follow that trend. 343 is probably going to break. I think we're probably headed back down to this zone. If this area breaks, that's going to be pretty catastrophic, right? We had a huge move here where tech massively outperformed for a very, very long time. 23% ended up culminating around 30% higher. And during this rally, that was a very, very powerful time for the broader markets. Again, it looks like tech is likely to be leading us lower here. So you do have to keep that in mind. Underneath the hood, we're seeing market weakness in those market leaders. Moving over to the SPY divided by the M2 money supply, absolutely terrible here, 1.5% down, broke that 25.91 level on a closing basis. We threw big wicks to it 2 weeks ago. We held it last week, and now we are through that area. Definitely expected to get at least to that low here. The chart here is a little bit different. You can see the low was already touched back 2 weeks ago, or almost there already, but realistically this is probably going to go to that 24.49 area. And ultimately, I've been saying this for a long time, I think this is realistically going to go another potentially 13 to 14% lower back to this 22.05 area. I think that's probably where we're going. Momentum bearish, RSI still very, very bearish. Do we hit oversold conditions before we get there? Maybe. You can see last time we were oversold on this indicator, it ended up being a very, very good buying opportunity. Kind of took you into that kind of May, potentially June time frame. We did go a little bit lower here in October, but you had really clean divergence. You had a much stronger RSI read on that October of 22 low, and then we ended up getting a very powerful rally out of it. So something to watch. Kind of gives you that culmination point, very close to culmination point on this indicator, but realistically still looking for about 13% lower based on this. Moving over to the Mag 7. Mag 7 was down about 2%, actually a little bit less than the NASDAQ, but overall still a very bad week. Momentum bearish, RSI bearish, huge volume on the selling. We had a really long culmination point. We've been talking about that for a while, and now we've had very consistent move down. 6 weeks in a row of selling. It's probably going to get to that 265.08 area. That gives you about at least another 2% lower. If we go back to this kind of low here from September we keep talking about, that would be about 7% lower on this one. Doesn't mean the markets are going to go 7%, but the Mag 7 could absolutely go another 7%. And then if you do look at the volume profile here, the volume profile says we could go all the way to the 240 area as your next kind of volume consolidation area, but the peak volume is actually all the way down in this consolidation here from the July up until kind of September time period of 2023. So keep that in mind. A lot of potential of downside. Short term, like I said, 7%, but if it goes here, that would be another 23, maybe to the highly traded zone, another 26, 27%. So the risk is still to the downside, absolutely a lot of risk to the downside. Again, doesn't mean it's going to happen immediately, but that is something that I am watching in my potential for the next couple of months. Moving over to Apple and Microsoft. Apple continues to outperform really, really well. You can see it was down only 0.17% or 37 cents on the week. The support is still holding at 217.62. We did close pretty much right there at 217.90. I think in the after hours we ended up below it, but For now, it's holding. The 55 is holding. Structurally, this continues to look quite bullish. This is certainly a pullback, waiting to see if these kind of zones hold. This could go as low as the 144. You can see back here in this zone, that's where it ended up bouncing. And if we did get a move like that, that would give you about another 13 to 14% lower. So we're not out of the woods here on Apple, but I would expect one of these zones to hold in there. And again, relative outperformance, very, very strong there for Apple. And then looking at Microsoft, terrible week, 3.18%. Again, relative underperformance from Microsoft. Still looking for this to go to that 144 EMA as the next zone. My level in there right around that 344.86 area, so another 8 to 9% lower. The 200 just behind that highly traded zone in there at 330.03. So that's where I would say we're ultimately going, but in the short term, you do have some trend support, a little bit of a volume profile in here around that 372.08 area. Again, very bearish, expecting this to continue to look bearish. Moving over to Tesla and NVIDIA. Tesla was actually positive on the week. It had massive selling, massive underperformance, but then we gapped up and rallied a little bit here. Momentum stepping back to bullish, RSI stepping back to bullish. Tesla does not really move with markets. It was up 6%, so if you're looking for a place to kind of trade bullish, maybe Tesla is the place to be. In terms of support, 255, resistance right now, 264. Could go back to the 280 to 301 area, maybe retest some of these zones. But Tesla, relative outperformance by a lot after being a huge seller here. And then NVIDIA, 6.82%. Semis have been leading markets lower again. One of the market leaders, not really leading markets to the upside, definitely looks bearish. Next zone here is that 95 area. That's about 12.5% lower. I think we could get there pretty quickly. Momentum still very bearish. RSI still very bearish. I would be patient on buying this one. I still think there's at least another 12%. And then this could go as low as 90.68. That would be the low back here from 5 August. Absolutely within play. This is almost a zone here, how tight those are for NVIDIA. You do have a trend support. You do have that next level, 106.6. That was the support. But again, clear high, lower high. I would expect this to go back into this area for sure. So Tesla, maybe a little bit better place to be. NVIDIA, not so much. Moving over to Amazon and Alphabet. Amazon was down 1.78%. Momentum bearish, RSI bearish. It's in a pretty interesting zone here. We're right at the highs of this consolidation. If it cuts through there, we're probably headed to 174, but right now it's holding up pretty well, down 1.78%, not terrible. Interesting zone here for Amazon. I think it'll probably be more of a victim of markets, where it's trying to be relatively strong, but markets are just dragging it down with the everything selling that we're seeing. And then you can see Alphabet terrible there, 6.13%, looks awful, going to that 150.26 level after this level broke here at 161.59, closed on the low. Everything looks bad there. Again, expecting at a minimum another 3.75% lower. Realistically, probably going to here about another 11.5 to 12% lower into that 138 area. That takes you back to this kind of consolidation here. You can see the volume profile, highly traded zone. Makes sense for it to go into that area once this area breaks. Doesn't mean we can't catch a little bit of a bounce from here. 150 could be an important level, but ultimately I do think we're going to go through that over the next couple weeks, maybe even months. Moving over to Meta and Broadcom. Meta continues to do fairly well relatively. You can see we're still well above that 55-week EMA. You can see in this zone continuing to hold. It was down quite a bit on the week, 3.25%, but in terms of support areas, it's still doing fairly well, especially relative to Broadcom. Broadcom's really the one that I wanted to talk about here. Semis have been absolutely terrible. Broadcom was down 11.76%. You had a massive candle on earnings, 25% higher. We have since more than round tripped all of that move. We're below the 55. Your next support is 158. So if you did get that move, that's about another 6% lower. Momentum bearish, RSI bearish. We're probably going to hit oversold conditions on the weekly RSI. I think there's a lot more downside to go here. Realistically, I would say we're probably going to go closer to that 15% lower. My next level there at the kind of top of this volume profile is 143.80. So that's the zone that I'm watching. I wouldn't really touch this until we got at least to there. Like I said, you might find some bounce here. 158 makes sense, but I just don't expect that to hold held in the short term. Moving over to staples and discretionary. Staples were positive 1.36%, continuing to be risk-off conditions. Investors are still looking for safe places to put money, and this is one of them. Staples positive on the week, continues to be a good place. Discretionary is down just 0.25%. We did try to go higher. We did fill some gaps and then immediately rejected from there. It looked a lot worse on the daily chart, but structurally here we're kind of intact. 197.14 is important. We did close below it by a few pennies, but nothing crazy. Next support is going to be 193.81. Let's see if we can find anything here on the volume profile. Got to go all the way back here to the November of 21 area. So we're already in a pretty important volume area, but the next most important is going to be down here. 179 to kind of 182, 183 makes sense. That's probably where we're going. Again, you have those longer term EMAs and SMAs down there. So if we do get that fall to there, it's about 8.5%. And then realistically, somewhere in here makes sense for me. Closer to that 11 to 12% lower. Again, not expecting any of it in the short term, but I do think that this is going to be going lower in the medium term. And ultimately, this is probably where we'll go. We'll round trip this entire move here, and then maybe we get a pretty substantial pop off of that. Moving over to breadth, these charts actually don't look as bad on the weekly charts. You can see we're kind of in the same zone that we've been in. 20-day was actually slightly positive, but the Friday candle was terrible, and I'm expecting these to continue to go to some lower lows, probably back at least to the 16 area on 20-day breadth, and probably at least to this 26 area here on 50-day breadth. Do we go all the way back to the 15 area? Maybe, maybe not. The momentum is not quite there yet. Maybe we get an acceleration next week, but structurally this continues to look quite bad with consistently lower highs and ultimately expecting at least a double bottom here. 26.3 is important. You can see we touched it back here in April, touched it again here in March after cutting through it back in December, but it could ultimately go back to that 15 area, which if it did, I think there's a decent opportunity there. Moving over to 200-day breadth, very weak here as well, back to the lows pretty much that we saw on that candle 2 weeks ago. We're back to the low from last week as well, expecting this to go back to this 36.23 area at least. If we overthrow it, your next level is all the way down at 29.39, still well below the 50 range. Most stocks are trending lower right now. So again, keep that in mind. Markets are trending lower, and the expectation is that they will continue to go lower based on that trend. Moving over to yields. Yields continue to trend down 2 weeks in a row. 50-day, 10-year, however, staying relatively flat over the last month. 2-year continuing to sell. So that kind of fits with what the FOMC was saying. We've been saying for a while we expected this to kind of trend back down to that 3.66 area. Somewhere between 3.66 and kind of where it is now makes sense for a kind of settling area for this over the next couple of weeks to potentially years based on what the FOMC is saying. Just 1 or 2 cuts this year, and then maybe 1 or 2 cuts next year would kind of bring it into this range for a while, and that is where we're headed. And then 10-year, pretty much in the same range. Makes sense. The yield curve is steepening at least a little bit, which is what you want. That's your normalized condition. Eventually, that does mean that there should be a recession potentially. We've been inverted for a very, very long time. Obviously, we are not inverted anymore. Eventually, that leads to recession 100% of the time. We just haven't figured out quite when that's going to happen. Moving over to the dollar on the weekly chart, pretty uninspiring chart here. It was down just 13 cents in the same zone that it's been in. Touched that 104.4 level, couldn't get above it, pulled back to the trend line, can't get below it. So we're stuck in this range here, still hanging out. Momentum is a little bit bearish, RSI is a little bit bearish. I still think this is potentially a higher low. I still think ultimately this is probably going to go a little bit higher in the short term, at least to 105.5, maybe as high as 106.8. And then we kind of go sideways in here, makes sense for me. Now that we've kind of culminated on the yield ramping, this was your kind of yield ramp. Now we're pulled back from there on this kind of cutting cycle, and I think we're going to kind of culminate in here, but we'll see. Either way, short-term bullish for me. Of course, if these levels start to break down, then you have your 200 SMA down there at 102.48. Moving over to bonds on the weekly charts here, you can see J&K still cannot get above that 200 SMA. It's been overhead resistance for a while. It's getting closer. We're still waiting for it to kind of consolidate into this range here around the 95 area, and then I think we'll get above it and start to see that kind of ramp from there. But we've been waiting a long time. We're still in this zone. That's fine. Want to see it hold in the zone. We're still well above the 144. That's as low as I would expect us to go if we did see any more selling. And then looking at TLT, had a big wick down all the way below the level 89.16. We were much lower midweek, and then we bounced really aggressive into the Friday, ended up down only 0.62 or about 50 cents. I still think this is a buying opportunity. I still think this is a zone of support, and I still think investors are looking to find items with yield. I just don't think we're going to be able to go higher until we get this kind of culmination move here, but we're still looking at rate cuts. That should put a floor under bonds, and I still think investors are looking for yields, and this is a good opportunity on TLT in my opinion. Moving over to the VIX was up about 12%. We touched the trend line here for a moment. We said this was a zone of support, and sure enough, we ended up bouncing really aggressive from there. Based on this move, we're looking for a push back into this zone here around the 28.9 area. That seems to be the zone where we kind of culminate over these last couple iterations, and I think that's probably where we're going over the next week to 2 weeks. So momentum bullish, RSI bullish, continues to look like the VIX is set to go higher. Moving over to my accounts, I think I made like $12 or something ridiculous on the week. Obviously, it's better to be up a little bit than down when markets were down across the board on the weekly charts. We just talked about how everything looks pretty terrible, so I can't complain too much. Still positive on the year when basically everything else is not. I do have some bonds here, still holding bonds just to kind of capitalize on some of the cash I have in these accounts. I obviously have no positions. I'm a little bit upset I didn't hold those calls into the close. I don't know, I just kind of chickened out on it, which was a little bit upsetting. You can see we sold basically another $2 after hours, so that was an opportunity, and I kind of expected that. I just didn't do it. I'm expecting a lot more bearishness next week. The thesis is very much bearish, so if we see any rallies, I would look for selling opportunities. I wouldn't look to play them to the upside. Doesn't mean we can't get short-term rallies, but I just expect everything to get sold off at this point. So no positions, just holding some bonds, just holding some yielding assets, and again, across my portfolio, really, that's what I'm holding. Things with yield, things that are going to hold up under this PE compression, and that's really what I think this is. I think this is a valuation compression, kind of a growth scare kind of market. Let me know down in the comment section what you think of the top 10% of earners. Are they going to drive us into recession, or are they going to continue to spend and keep the economy flowing? Let me know. Otherwise, like and subscribe if you got any value out of this video. Make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.